Let's take a look at that Canadian dollar following the Bank of Canada. You can see it's down about 0.7%, even as the Bank of Canada remained on hold. The market is interpreting that he left the door open for a rate cut. A rate cut is certainly something that we are expecting south of the border. And despite what appears to be diverging paths when it comes to where the Bank of Canada is headed versus the U.S., speaking after his latest rate decision, Pola said market participants shouldn't read too much into those differing paths.
There's a lot of talk about divergence, but actually what has occurred is more of a convergence. That is, U.S. interest rates have come down to about the same as our levels because they went up farther in the first place. So I would say we are kind of converged in this situation right now, and our outlook for the two economies is not that different.
All right, let's get some analysis to that rate decision. Stephen Brown, senior Canadian economist at Capital Economics, joins us in studio. Thanks so much for being with us.
Hi.
So let's talk about Bank of Canada, Stephen Pola's assessment of what is not a divergence, rather a convergence. What did the Bank of Canada do right in the past couple of years? Were they right to effectively stop hiking rates at a certain point where the Fed just continued to go up and now they're forced to walk that back?
I think you could make that case to a degree. So the Bank of Canada stopped hiking rates last October, whereas the Fed went a bit longer. And obviously that was a contributory factor towards the correction in markets that we saw last year. I think the issue facing the bank now, though, is that it's facing some signs of domestic strength still. So, for instance, the rebound in the housing market this year in Canada. But the global backdrop is continuing to deteriorate. So we actually think the bank's forecast for global GDP growth and growth in the US in particular are still far too strong.
Now, Capital Economics is never afraid of being an outlier, but at this meeting, you thought that there could be a chance for a rate cut. In fact, I think back in July, that's what you were calling for, but we didn't get it. Why?
Yeah. Yes, so we did think back in July that they would cut rates at this meeting. We revised that slightly, essentially just on the back of that stronger than expected housing market. So we knew we had the drop in mortgage rates, but I think the speed at which that fed through to a rebound in home sales was quite unexpected. But even though we had that, we are now getting the message from the bank that that rebound in the housing market alone isn't going to be enough to rescue the economy, because we're talking about maybe a contribution to GDP growth somewhere between 0.2 percentage points. Whereas if you look at slower growth in the US, because Canada sends sort of exports worth around 30% of GDP to US, that's a much larger effect on the economy, potentially. So I think we had sort of three key changes from the bank today. One is that it actually cut its forecast. They weren't that strong to begin with, but the Bank of Canada is now forecasting a 12-month period of below potential GDP growth. The second change was that the bank no longer told us that it thinks policy is stimulative. So Pola himself did actually backtrack a bit from that in the press conference, but I think that's quite a key sign as well. And then the third most interesting point, which I've sort of forgotten a bit. We'll return to that in a minute.
Well, one of the things that is striking about this, and if you watch the press conference, was how many people were trying to figure out how close were you to cutting, what is your thresholds for cutting. It seemed like the reporters were getting a little bit frustrated about trying to extract an exact answer. Do you feel like, I think now you're calling for a December rate cut, is that correct?
Yes, that's correct.
Do you feel like you know what the threshold is?
Yes, so the third point was that Pola has actually told us that they discussed whether the bank should enact insurance cuts, similarly to how the Fed described them during the first cut in July. What was interesting is one of the key reasons we thought the bank, if it didn't cut, the reason would be that it was afraid of juicing the housing market, so to speak. But Pola has actually told us today that the bank is less concerned than before about that because of the new mortgage regulations, which should reduce those risks. So the key reason seemed to be why the bank didn't cut is because it still thinks that inflation will remain somewhere near 2%. So its forecast for next year is 1.8%. But that suggests to me that the barriers to a cut now are pretty low. So we either need to see inflation come in lower than the bank expects in the next few months, or we need to see the global backdrop deteriorate a bit further. And we actually think both of those things are quite likely. So if you look at the bank's forecast for US GDP growth for about 1.9% for the coming few quarters. If we look at the surveys in the US, they're consistent with growth of between 0% and 0.5%. So clearly we need to see an upside surprise in the US data for the bank not to end up cutting rates in December, I think.
He also talked specifically about the currency, actually a lot more than I can recall him doing in the past, and we know central bankers sometimes are hesitant to mention it at all, but talking about how it's not necessarily the Canadian-US dollar cross, but that he has noted businesses are telling him that it's the cross between the Canadian dollar and other currencies, as the CAD has rallied against those crosses, that could be hampering business activity or export activity, making Canada seem relatively more uncompetitive. What did you make of that?
I think that's right. So, I mean, the Canadian dollar, US dollar exchange rate is still really important. I think that's where the Fed rates cuts do come in as being an important issue, because that's essentially the relative price of goods between the two economies. But at a time when Canadian exporters have told us that they want to diversify their exports to other regions, we've obviously had some geopolitical issues with China, which is preventing much growth there. And now we're seeing slower growth in the Eurozone, and that's weighing on the sort of exchange rate between the two economies on that basis. So it's really exporters are being faced with problems from all angles at the moment. Offsetting that is we are still seeing strength in the services industry, and part of that is services exports, which are maybe less sensitive to exchange rate. But I don't think the Bank of Canada can continue to ignore these risks and just focus on a few strong points for much longer.
Stephen, thank you so much for your insight today. That's Stephen Brown, Senior Canada Economist at Capital Economics.